Hello everyone! In this video I want to talk to you about Modigliani and Miller's proposition 1 and 2 in the presence of taxes. So for some context, Modigliani and Miller showed that if capital markets are perfect, in other words, we're living in a world where, say, there are no corporate taxes, there are no costs of financial distress, and a bunch of other assumptions, capital structure does not matter. In other words, value of the levered firm is the same as the value of the unlevered firm, which is another way of saying that as you change capital structure, your weighted average cost of capital doesn't change. In this video, my goal is to help you understand what happens to their main result once we relax the assumption of no corporate taxes. Does capital structure continue to be irrelevant when there are corporate taxes? And it turns out the answer to that question is no. Modigliani and Miller showed that if we live in a world where there are corporate taxes, and that is the only assumption we relax, value of the levered firm is going to be equal to the value of the unlevered firm plus T times B, where B is some level of debt that the firm is planning to hold on to forever. One of their assumptions was that firm maintains the same level of debt perpetually. Let's suppose that level is, say, $100,000. So B represents this $100,000. In that world, value of the levered firm will be more than value of the unlevered firm by T times B, where B represents the level of debt and T represents the corporate tax rate. Now, some of you might be wondering, what is this T times B? Actually, this is a very, very important term. And I'm going to explain where this comes from, but please understand MM1 now looks like this. Capital structure does matter. Debt makes your firm more valuable than it would be if it had no debt. By how much? By T times B. The reason why leverage makes a firm more valuable is because interest expense is tax deductible. Here's one way to see this. Imagine that you're living in a world in which all of the firm's assets are funded entirely with equity. There's no debt, so the firm is unlevered. However, corporate taxes are not zero anymore, which means that the government is sitting to take a certain fraction of the earnings before interest and taxes that these assets are going to generate. And because you have no debt, you have no interest, which means that EBIT is also going to be the same as your taxable income. And that means that if you fall in a 25% tax bracket or 20% tax bracket, that fraction of the taxable income is going to end up going to the government. So this orange quadrant here represents the portion that is going to the government. And you can think of this blue shaded area as the value of equity. And the main point here is the value of the equity is the same as the value of the firm because the firm is unlevered, and you can therefore call it value of the unlevered firm. So the key point here is that of this entire big circle, only this blue shaded area, this represents value of the unlevered firm. Now, what happens when there is debt? When there is debt, it's the same assets that are now funded with part debt, part equity. The same assets generate the same earnings before interest and taxes. However, because you now have debt, that means that you have some interest expense. And because of that interest expense, your taxable income is now lower, which means that what ends up going to the government, which is now represented by this orange portion of the pie, is now less. This green area B represents the portion that is going to the debt holders. I'm going to call it the value of debt, and S as before represents the worth of the equity. And we can think of the value of the levered firm, in other words, the value of these assets, as the sum of the value of debt and the value of equity. So VL equals B plus S. And as you can see, the sum of B plus S is going to be greater than just S by itself when the firm was completely unlevered. It is in this sense that value of the levered firm is going to be more than the value of the unlevered firm because the portion of the entire pie that is going to the government is now less. Now, in my experience, students tend to have difficulty really grasping this concept. So let me try and give you a different example. Imagine that there are two friends, Patrick and Sam. And let's suppose both Patrick and Sam want to eat a pizza. So Patrick picks up the phone, calls Domino's and say, hey, I'd like to order a pizza. I'd like some cheese, some chicken, some veggies, all that. And the Domino's guy says, yeah, okay, that's going to be $20. All that is fine, except that as Patrick is about to hang up the phone, the Domino's guy says, well, we're running a Patrick special today. If you're ordering the pizza and the name on the credit card is Patrick, Domino's gets to keep, say, 25% of the pizza. So Patrick, if you place the order, by the time the pizza is going to come to you, of the 8 slices, you'll only see 6. Now let me ask you, if both Patrick and Sam are planning to share the pizza, what do you think Patrick should do? That's right. Patrick should hand over the phone to Sam and say, hey, Sam, your name is not Patrick. Why don't you place the order? And when you're going to place the order, we are going to get the full 8 slices. Domino's doesn't keep to get 25%, and we can still split it 50-50. And that is exactly what we are saying. If we are living in a world where the capital that is provided by debt holders is favored in the sense that any payments to them in the form of interest are tax deductible, the government doesn't get to keep as much of the pie. In such a world, it makes sense to fund the assets with as much debt as possible. In the world of finance, we refer to these tax savings as interest tax shield, which I'm going to abbreviate as ITS, interest tax shield. Interest tax shield is a fancy way of saying how much are we shielded from taxes because of the interest expense. What Modigliani and Miller essentially said is that as we take on debt, we are able to save money in taxes because of the interest expense, and so the value of the levered firm should be higher than the value of the unlevered firm by the present value of all the money that it's going to save in taxes because of interest expense. In other words, the value of the levered firm should not be just equal to value of the unlevered firm, but it should be higher by the amount of present value of all the interest tax shields. Now, it turns out that Modigliani and Miller assumed, for the sake of simplicity, that the firm holds a constant amount of debt forever. That makes the math a little bit easy. Let's suppose that the firm borrows some amount, say B, call it $100,000. And let's suppose the cost of debt, in other words, the interest that the firm is paying on this is like 5%. And let's further assume that the corporate tax rate is 25%. Further assume that the firm is planning to hold on to this $100,000 forever. This means that each year, the firm's interest expense is going to be 5% of this $100,000. So interest will equal 5% of $100,000, which is $5,000. And notice, how have I calculated interest expense? It is calculated as RB times B. Now, if I were to represent this on a timeline, the firm goes on forever, and each year the firm's interest expense is going to be $5,000. Now, the next question, how much money is the firm going to save in taxes because of the interest expense? Well, because the tax rate is 25%, this means that the firm is not going to have to pay 25% on this $5,000. Basically, the taxable income is going to get reduced by $5,000 each year. So your tax savings, or what I refer to as interest tax shield, that is 25% of this $5,000, which if you do the math is going to give you $1,250. $1,250 is derived as T times RB times B. So 0.25, and we already know that RB times B equals $5,000. If somebody asks you what is the present value of all this $1,250 that you're going to save in taxes because of the interest expense, this is a perpetuity. You're getting the same cash flow forever. The present value of all these interest tax shields is simply going to be equal to $1,250 divided by your opportunity cost. Your opportunity cost here is the cost of debt, which is the next best rate at which you can borrow. So divided by 0.05. And if you take a look, how did we get this $1,250? We got this as T times RB times B, and we are dividing by 5%, which is RB. Hey, what do you know? RB cancels out with RB, and what you get is T times B, which is exactly what Modigliani and Miller said, that value of the levered firm is going to be equal to value of the unlevered firm plus T times B. But the important thing to note here is that T times B is merely the present value of all the interest tax shields that the firm is going to get. So here's the punchline. In a world with corporate taxes, value of the levered firm is equal to value of the unlevered firm plus the present value of all the money that it's going to save in taxes because of interest expense. However, if and only if debt is constant and perpetual, present value of all the interest tax shields is simply equal to T times B. And then and only then, value of the levered firm equals value of the unlevered firm plus T times B. And one can equivalently show that in such a world, the weighted average cost of capital is not just going to be B over B plus S into pre-tax, but the after-tax cost of debt. So RB into 1 minus T represents truly your cost of borrowing. And then S over B plus S into the cost of equity. And it is precisely because your after-tax cost of borrowing is now lower, is that as you borrow more and more, your weighted average cost of capital is going to fall. Please understand that saying that value of the levered firm is going to be more is the same thing as saying that as you take on more and more debt, weighted average cost of capital is going to be lower. Through some fancy math, you can also show that in this case, Modigliani and Miller's proposition number 2 is also going to change a little bit. When there are no taxes, Modigliani and Miller proposition number 2 says that the cost of equity is simply the unlevered cost of equity plus B over S times R naught minus RB. However, now that there are taxes, it turns out that you will have a 1 minus T expression appearing over here as well. Just like you had a 1 minus T show up in the weighted average cost of capital formula. So it is useful to see all of this graphically as well. So if I were to measure the debt to equity ratio of a firm here, and if I were to measure firm value here, when a firm has no debt, the firm is going to have some value, call it VU. This is value of the unlevered firm. As the firm is going to take on more and more debt, value of the levered firm in this world is going to be higher and higher and higher. So this upward sloping line represents VL, which is starting from VU, but then if debt is constant and perpetual, it is increasing by T times B. More debt to equity implies more debt, meaning more present value of interest tax shields, and so this line is upward sloping. Saying this is the same as saying that if I were measuring debt to equity ratio here, but now I'm measuring cost of capital on the vertical axis, then when the firm has a debt to equity ratio of 0, it will have some cost of capital. Specifically, it will be the cost of equity because it has no debt. We call that equity unlevered equity. So we represent cost of unlevered equity with the symbol R naught. As the firm is going to take on more and more debt, the weighted average cost of capital is going to fall. We can represent cost of debt as being some level around here. So this represents RB. However, RS is an upward sloping line and its equation is given by MM2. And so this then completes our picture of MM1 and MM2 in a world in which there are corporate taxes. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.